Hello everyone, welcome back to our channel and welcome back to this particular edition of Capital Insights from Punjab Capital Research. Today we're going to be talking about the token export economy and we are going to do a deep dive into China's pricing arbitrage, the global inference flows and the distribution versus monetization divide. Let's first start with the new commodity that is available and a familiar asymmetry. Now, the emergence of AI token as a measurable unit of economic activity has produced a new competitive surface in the global technology race. On Open Router, the aggregation layer that routes developer traffic across more than 300 frontier and open weight models, Chinese labs have moved from periphery to the podium inside 12 months. 4 of the top 10 models by token throughput between mid-March and mid-April were built in China, displacing incumbents that until recently held the board. Now, the mechanism out here is price. Minimax, Moonshot, Qwen, DeepSeek, and Xiaomi are listing frontier-grade inference at roughly 1/5 to 1/20th of comparable pricing from OpenAI, Anthropic, and Google DeepMind. Alibaba Cloud's Qwen sits near the extreme of that spread, and several of the models are offered free at the point of developer access, subsidized by strategic intent rather than unit economics. The question for allocators out here is whether the distribution share translates into durable economic position. The data at this point suggests that it does not. Leading Chinese AI firms reported 2025 revenues in the band of roughly $15 million to $100 million. Annualized revenue at OpenAI crossed $25 billion, with Anthropic reportedly above $30 billion. The ratio of usage to monetization is the single most important variable for any modeling exposure in this space. China's role in the token economy today resembles a distribution play wrapped around compute capacity it does not fully control. That can change, but it has not yet. And this brings us to what the Open Router tape is telling us. Now, Open Router is the closest the market has to a public tape for AI inference. The platform processes over 30 trillion tokens per month and integrates more than 300 models behind a unified API, allowing developers to switch between providers and underlying compute environments in real time based on latency, price, and the output quality. The research from MIT's Initiative on Digital Economy places Open Router at approximately 1% of trackable global token consumption. Small in absolute terms, but directionally informative as a leading indicator of developer preference. 3 observations matter out here. First and foremost, the shift is recent and sure. Secondly, the token demand is agentic and not conversational. And thirdly, visibility is not revenue. Let's talk about the first observation, which is that the shift is recent and sure. Now, through the end of last year, the top 3 slots at Open Router were occupied without contest by OpenAI, Anthropic, and Google. However, from the turn of the year, the intermittent top-tier appearances by Minimax, Moonshot, DeepSeek, Qwen, Xiaomi have become a feature of the leaderboard. The transition is not a curiosity, it's an ongoing rotation. The second important factor out here is that the token demand is agentic and not conversational. The most token-intensive workloads on the platform are autonomous agent frameworks and developer code generation tooling. A single agent run consumes orders of magnitude more tokens than a chat interaction. And as the agent adoption accelerates, the aggregate demand scales non-linearly, a dynamic that compounds both the strategic value of the low-cost inference and the strain on the compute infrastructure. And lastly, visibility is not really revenue. Herein, we would like to stress that Open Router captures a fraction of the global token flow. It excludes enterprise deployments made directly through first-party APIs from OpenAI, Anthropic, and Google. And it also excludes the consumer-facing products such as ChatGPT and Gemini. Chinese models' visibility on Open Router, amplified by free or near-free pricing, should not be conflated with the share of aggregate economic surface. When we look deeply into the pricing architecture of the token exports, the single most distinguishing feature of the Chinese participation in the global token economy is price. The spread between the Western frontier models is wide enough to restructure developer calculus on any cost-sensitive workload. Herein, you can see a snapshot of what we are talking about in terms of model, in terms of origin, in terms of indicative price, and the relation to Western peers. Now, what we can say from this snapshot is that 2 readings of this pricing architecture are possible. First and foremost, the competitive reading, and second, the structural reading. Now, when we are talking about the competitive reading, we can see that the Chinese labs are pricing to the marginal cost of inference or below it, mainly to establish the developer mindshare, accumulate usage data, and position for the enterprise conversion that tends to follow the open layer adoption. Now, this strategy mirrors the well-worn playbook of the Chinese export industries from solar to EV: subsidize volume, compress unit margin, and compete on the total cost of adoption rather than the feature frontier. However, when we look into the structural reading, we see that the price is this low or inconsistent with the sustainable returns on the underlying compute capex. They are a function of the strategic subsidy, favorable domestic energy inputs, and willingness to trade near-term economics for positioning. Now, whether that positioning converts into pricing power over the medium term depends on quality convergence at the frontier, on enterprise trust in Chinese wind systems, and on the regulatory response in the buyer jurisdictions. So essentially, what we have is a distribution versus commoditization of the compute. The phrase token export has entered the discussion as shorthand for cross-border inference served by Chinese models, but the underlying mechanics are closer to model distribution than to genuine cross-border trade in compute. Analysts at the China Academy of Information and Communications Technology have flagged this directly. Many Chinese models appearing on Open Router are hosted on overseas cloud infrastructure with inference running outside mainland data centers. The distinction is economically material. A token served from a US or a Singapore data center running Chinese open weight model represents weight level distribution by Chinese lab, but the compute revenue captured by hosting provider. The value chain splits: model developer versus compute provider. Absent vertically integrated cross-border compute, Chinese labs export the artifact and not the infrastructure that monetizes it. So essentially, what we are trying to say out here is that the token served on foreign infrastructure is not an export of the compute. It's an export of the weights. The difference is where the margin sits. Now, this has three implications worth flagging for the allocators watching this particular space. First and foremost, the compute rent accrues to whoever owns the stack. The hyperscale cloud providers, for example, AWS, Azure, GCP, and specialized inference layer represented by firms like CoreWeave and Lambda, send downstream on the model and capture the recurring compute spend. Chinese labs distributing through these rents participate in the demand curve but not in the infrastructure capex return. Secondly, we have to understand the weight distribution is reversible, but infrastructure is not. The open weight models can be delisted or throttled on the platform layer as the regulatory and geopolitical pressure intensifies. A model's presence on Open Router or on a hosted Western cloud is a policy contingent position, not a secured economic channel. Data center infrastructure, by contrast, is a durable asset with multi-decade depreciation schedule. And lastly, we need to talk about the domestic inference that will eventually close the loop. Token consumption inside China has expanded from roughly 100 billion per day in early 2024 to about 140 trillion per day by March of 2026, with the growth of over 40% in the first quarter of this year alone. If the domestic build-out of the compute capacity continues on the current trajectory, Chinese labs will increasingly serve their own workloads on domestic rails. That is the point at which token export begins to mean something closer to the literal sense. However, what's the most important thing out here is the monetization gap, and that is the headline. For all the noise about the share of leaderboard, the revenue arithmetic is the cleanest summary of where the industry actually sits. This snapshot gives you the company and the reported annualized revenue. When you are talking in terms of OpenAI, you have 25 billion annualized revenue in terms of ChatGPT consumer and enterprise API. When we are talking about Anthropic, we have 30 billion in annualized revenue in terms of cloud API and enterprise-led. When we are talking about the leading Chinese labs, we have 15 million to 100 million, as we talked about before. And when we are talking about the largest Chinese cohort, which is up to 100 million, we have outliers only. Cohort median layer is lower. So essentially, the numbers are implying the revenue gap of between 2 and 3 orders of magnitude between the dominant Chinese lab and their US counterparts. Even granting generous growth assumptions and assuming conversion of the domestic enterprise buyer, the trajectory of convergence is measured in years and not in quarters. This is before accounting for the compounding effect of reinvestment. The US leaders are recycling revenue into training runs, talent, and hyperscaler commitments at a pace that structural subsidy alone will struggle to match. For the institutional allocators, the takeaway is that the token usage share and model leaderboard position are upstream indicators. Revenue, gross margin, and the composition of the enterprise contract backlog remain the variables that actually discriminate between the durable and the transient positions in the AI value chain. So essentially, what can be said is that the token economy has opened a second front in the global AI competition. Share of usage is real and is moving. share of economics is moving considerably more slowly. Both matter, but it's important that we do not confuse them. That's all that we have for you in this episode of Capital Insights. Hope you find this episode insightful. Stay tuned in for our next one.